How to define a transfer pricing methodology. Transfer pricing methodology is an approach to determining the transfer price. Let me give you an example. Imagine the Vista Group, a multinational company that manufactures and distributes widgets. There are three key business processes: manufacturing, distribution, and sale to the final customer. Usually, modern business involves the registration of separate companies or entities that form a group of companies. It is often the case that these companies are located in different countries, and local authorities control the tax compliance of these entities. In essence, tax authorities want to ensure that the business profits are allocated to the parts of the supply chain that generate value. One of the most critical aspects of international tax compliance is transfer pricing, the process of establishing prices in intercompany transactions. In our example, there are two intercompany transactions. The manufacturing company sells widgets to the distribution company, and the distribution company sells goods to a sales company. In both transactions, Vista Group needs to establish pricing methodologies that comply with transfer pricing regulations. For example, the manufacturing entity can price goods based on the manufacturing cost and a markup, and the distribution company will determine prices on a resale margin basis. That is what we call transfer pricing methodologies, the approaches to setting the transfer price. In real life, multinational companies have lots of different transactions, including intergroup services, loans, financial transactions, and asset transfers. The transfer pricing management system aims to set, track, and control transfer pricing models or methodologies and ensure the consistency and central monitoring of the transfer pricing process. Without a proper framework, the control gap can grow substantially when the size and complexity of the company increase. While tax managers can manage transfer pricing methodologies in a traditional way using Excels, Word documents, and emails, there is a better approach called digital transfer pricing. That's why Abidia has a dedicated digital workflow that allows defining and controlling TP methodologies in any multinational company. The process includes 8 steps: defining TP models, specifying functions, assets, and risks, adding definitions, selecting transfer pricing methods, mapping transactions to TP models, mapping TP attributes such as benchmarking studies, identifying profit level indicators, and validating arm's length nature of the transaction. Digital transfer pricing applications are built around the workflows that allow defining TP methodologies in a structured and consistent way. When defining the TP methodologies, the first step is to add the TP models. TP models are particular methodologies applied to a set of transactions. Then indicate functions, assets, and risks, in other words, functional analysis. Next, specify the definitions. For example, one of the sides of the TP model may be a contract manufacturer, while in the other model, a limited or fully fledged distributor. In the following step, you need to select transfer pricing methods and indicate appropriate characteristics, such as the tested party and the profit level indicator used. Next, map the transactions to TP models. In this step, you indicate which transactions were priced in accordance with the preset TP methodology. Map TP attributes, like benchmarking studies, to transactions. By this, you let the application know which benchmarks are relevant for price setting or price testing. Next, indicate profit level indicators. These can be ex ante or ex post results. And, in the end, validate the arm's length nature of transactions, ensuring the prices are in line with transfer pricing methodologies. By using a digital transfer pricing platform, you do not just solve one problem, like the preparation of transfer pricing documentation. Instead, you build an end-to-end system that enables full real-time control over your transfer pricing, where all applications are integrated and synchronized.